Here we go. We're going to run over a quick tax plan. So first of all, the variables we're going to be discussing are the W-2 income and the K-1. It's going to be for an S corporation, and there's going to be rental property. So this is a tax projection. Tax projection is part of the tax plan. So first of all, we're going to be comparing 2020 to 2021 projection. And so here we have the number of months that are going to be used for the projection. For example, if we are in the middle of the year, then we would plug in a 6 over here, and then all of the revenue and expense items would be multiplied by 2. If we were in the first quarter, we would plug a 3. If we were in the first month, after the first month, we would plug a 1 over there, and everything would be multiplied by 12. We're going to assume, well, let's assume that this was the third quarter. So that's what we're going to update over there. And again, the assumptions are going to be the S corporation is going to be issuing a K1, and that it's not a passive S corp, you are actively involved in that S corporation, that there is passive rental real estate income, and that there is a W-2 as well. Those are the variables. So here we go, the 1040. This is going to be the summary where we're basically going to be getting the taxable income from. So here in 2020, they had the $100,000 in W-2. Let's assume that there is expected to be $120,000. So this W-2 is not going to be multiplied by any fraction. It's just going to be the expected for the entire year. All right, so let's say they expected to have a raise, and so they have $120,000 W-2 income. Now, the next step is, okay, so we already updated that and put the W-2. Now for the P&L over here, that's going to flow through the K1. Here's the P&L right here. So this is for, okay, we have January through September, right? So this would be changed depending on whatever the number of months are. Nothing should be attached to there. So this is just for reference purposes. And here's the S corporation. So let's assume that they had, let's say, for the first 9 months, they had $1 million in income. And let's say the total expenses were about $650,000. So that means that their current net income is $350,000, and their projected is going to be $466,000. So that flows through over here to the K1. And you see it's very different from 2020. So that's to make it a little more realistic. Let's say that they currently have $3.5 million, and they're expected to have, let's say, $1,200,000. So then their expected business income that's going to flow through to their K1 is going to be 3.06 million. That is going to flow through over here. Right. One thing we didn't do yet is the Schedule E. So if we go to the Schedule E over here, let's say in 2020 they had $50,000. Let's say they had $90,000 rental income. Again, we are just using some assumptions obviously over here. Let's say they had total expenses were $180,000. We're just going to combine it for simplicity's sake. And then there's going to be some limitations on the Schedule 8582, which we're not going to go into too much detail over here, but there's going to be some limitations depending on what their AGI is, what the modified adjusted gross income. We're assuming again that they are not a real estate professional. Right? Assuming that they're not a real estate professional. Otherwise, if they are a real estate professional, then all of their rental losses would be netted against their active income. Okay, again, so the assumption is that they're not a real estate professional. So then we're going to go over here, as we just did, into the Schedule E. We put in So here they would have a $90,000 loss theoretically. However, because they're going to have a modified adjusted gross income that is larger than the $100,000, then they're not going to be able to take any losses. So as we can see over here, if, for example, let's say they didn't have any business income, right? Then we'll see over here that they would be able to take a $25,000 loss. $25,000 loss is because $25,000 on their Schedule E income. So let's just leave that for now and just go with this one particular scenario. In this scenario, so they're going to have a adjusted gross income of 3.186, which comes from this Schedule 1 as well, plus their W-2. And the Schedule 1 is basically going to be the combination of their K-1 and their Schedule E. Right? So it really is for passive income or S corporation income. So it's for real estate income and S corporation income. So, but there's not going to be any real estate income or loss in this scenario. Now, if this was less, then it would be added together. Then their Schedule 1 would be a total of 3.12, which is a combination of their K1 and their rental real estate. So 3.067 plus the 53,000, right? 3.067 plus 53,000 should give us a 3.12, as we can see over here. Yeah, exactly. So then they're going to have the 1040. It's the that's the total income. 3.12 plus the 120 is going to give us 3,240,000. Again, another assumption is they're taking the standard deduction, right? Standard deduction taken, right? Going to add this assumption over here. All these variables are going to make a difference in real life, but just to get an idea, right? So then we have their taxable income is going to be 3.215. We go over here to the tax summary, and we're using the, well, here we go right here, 3.215. And so for 2021, if we were running this for September through September of this year, and let's say they were married filing jointly, another assumption, right? Well, I guess it doesn't make a difference. We could just look over here at what it would be if they were single. Then their total tax would be $1.1 million. Right? That's basically the combination of all of these numbers over here, $1.1 million. So that is that. That is an example. That is a tax plan, a tax projection. So really, the main points, you want to think about the income items, right? In the scenario, it's going to be a K1 from the S corporation, which is going to be it's going to reflect the P&L of the business for this S corporation, right? So that business P&L is going to basically flow through to your K1. So you want to project that out for the entire year. Other income, your W-2, you want to make sure you're accounting for it for the entire year. And the other item is going to be the rental income or loss that you're going to be projecting throughout for the entire year. Now, projecting it is just the first step. After projecting it, then you can say, hey, look at this tax liability, potential tax liability. What can we do to mitigate it? And that would be another video, but there are many different types of strategies that could be implemented to mitigate this tax liability. Anyways, I hope you enjoyed. I hope you learned something. If this was helpful to you in any way, please hit that like button and subscribe if you haven't done so already. And feel free to leave any comments or questions, and I will get to them, do my best to get to them. Have a wonderful day.